Hello, I am price earnings ratio, and I want to share my screen. We want to talk about what to do when the stock market goes down. Okay, so everybody, a lot of people in this space, some people are teaching the stock market. That's what I do. I teach the stock market. I invest long term, and also I do a little bit. I mix it with a little bit of trading, but I'm not a big trader. I only use trading to hedge my account or to keep my account up. And yeah, I do like trading, you know what I mean? But the best way to go in these markets is to invest long term in good companies. And I pulled up a company here. Again, this is not financial advice. I'm not a fiduciary. So this is only for educational purposes only. But you know, I've been in the stock market for over 10 years. I've been in the stock market, reading books on it. Under still, I take courses. I take continuing education courses on the stock market. I think you should be always. It is a trade. So, and initially, my background is as an electrician. I'm in electrical trade with the union, and um, we always take how you say it, continuing education classes. So this is a trade as well. So you should always be taking educational classes and keeping your knowledge up on the stock market. And if you don't have the time to do this, then you should hire a certified financial planner or a certified financial advisor. I am big on that. You won't hear a lot of people on out here saying that, but that's face the reality. How many people got time to just sit here and just read financial papers? How many people have time to sit here and just read a bunch of books when you got a 9 to 5? Most Americans are are have a 9 to 5. We have a job. So I'm not the one to tell you to quit the stop to quit your job and start trading, because that'll be the worst financial advice that I can ever give. And whoever's saying that, they're responsible. When you have a large audience, when you have a large audience, people following you, and you start telling them that they could quit their job and start trading on the stock market, that is asinine. You know, that is bad financial advice. No, if you want to keep your job, and if you want to trade, trade. If you're trading, there's a lot to learn about trading, and the best traders don't even the best traders in the world, contrary to belief, don't do better than long term investors. They don't. It's proven. So, in a down day like November 13th, Thursday, when the stock market had a correction, what is a correction? The correction is basically saying that if a it's basically a sell off. So if people don't believe that the stock is should be that price or it's too high, then they kind of sell it off. It's something called the efficient market hypothesis. Efficient market hypothesis. Let's just look that up. It basically said let's go see what that is so I can show you. It's basically saying if every stock, every price of a stock that you see on the stock market is supposed to be that price. And if that stock is not supposed to be that price, then it, investors are going to sell it off. A lot of investors are going to sell it off, and the stock is going to drop. So if it's not supposed to be that price, then the stock will drop. And this is called the efficient market hypothesis. So let me go just make sure that is what it is. We're gonna go to take a trip to Google. 1 second here. What is the efficient? 1 second. Efficient. This is education. So stick. You want to stick with me. Efficient market hypothesis. Okay. So let's just go here. You want with me, and I'm not going to be long, but these are in a sell-off that like November 13th, Thursday. The traders they got swept. They lost a lot of money, but they ain't coming on here and saying that they lost a lot of money. They lost a lot of money, but you know who didn't lose a lot of money? Long-term investors. Long-term investors that bought good companies. They live to see another day. The thing is this. Um, the thing is this. If you had $100,000, what would you rather do with that? You rather give it to a trader, a professional trader, or do you rather give it to a professional long-term investor? If you had $100 and it was your last, what would you like to do with that money? Would you give it to a professional trader, or would you give it to a professional long-term investor? I'm going to give my money to a professional long-term investor, because the trader eventually is going to get wiped out, because a trader can't make money every day. That's impossible. If you can make money every day in a market, the rich people would be doing it. That understand the stock market, the rich, there's nobody that's making money every single day in the stock market. Why? Because there's nobody on the face of this planet that knows what a stock is going to do. Not even Warren Buffett. Not even Warren Buffett. So the best there's nobody has a crystal ball. So the best way to play this, or the best, I don't like to use the word playing and investing, because I don't want the subconscious thinking that you play, that it's okay to play with your money. This is your money. This is long term. This is serious business. And when you're investing, or listen to these people online and telling you to trade every day, you can make money every day. That's not possible. That's impossible. They may make some money in about a month or about a week from now, and that'll make up for the losses that they took from this day to that day. But the best way to go about the stock market is to hold long term. So here's a terminology that I want y'all to get used to: efficient market hypothesis. Okay, what does this mean? Okay, let's go right here. So what is efficient market hypothesis? EMH. So the efficient market hypothesis is a hypothesis that states that share prices reflect all available information, and consistent alpha generation is impossible. It is also known as efficient market theory. Okay. The implications of efficient market hypothesis are that investors can only obtain higher returns through buying riskier investments, and that a low cost passive investing strategy will usually achieve the best long term results. Did you get that? This ain't. It's not. I'm not knocking the traders. I'm just talking to my audience. See, I may not be for you. I may not be for you. But just know this. Just know that my audience, my audience, I'm gonna give you um, the best information, or the best, suggestions or recommendations that I can give you. That's what I'm gonna do. You know what I mean? Because I don't want to see you. Because I don't, even though I can't see who's on the other line here, I don't want you losing a whole bunch of money, because I know how that feels. I put myself in your shoes. You come to my chat, excuse me, you come to my channel to get information. So it's only right. It's only right that I try to give you the best information that I can. And I recommend that you should hire a certified financial planner or a certified financial advisor, because they can manage your money for you, and they're doing it every day. But don't stay out of the stock market. Let's keep going. We're right here. Efficient market hypothesis has its critics, who believe it is possible to beat the market, and that stocks can deviate from their fair market values. They point to the 1987 stock market crash, and investors such as Warren Buffett, whose strategy of investing in undervalued stocks has earned billions, as evidence. So This is the if you never heard this term before, this is what that is: efficient market hypothesis. So the best way to like I said right here, um, so the implications of efficient market hypothesis are that investors can only obtain higher returns through buying riskier investments, and that a low cost passive investing strategy will usually achieve the best long term results. So here, let's go back. So that's why when I was first sharing my screen, this right here is a Vanguard ETF. So notice that when on November 13th, right, we had a correction. Some people like to say stock market crash, but we had a correction. So November 13th was Thursday. So we had a little correction. This stock was at so, but look at the percentage down. Even with a correction, look at the percent is down 0.19%. 0.19%. So even if you bought it right here, 336, and it went to $326. I mean, who cares? Because you're holding long term, and this is a value company. This Vanguard ETF has this information, has these companies in it at the bottom. And I'm wrapping this up so look at it. This has Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, Alpha, Tesla, etc. So you know these companies are gonna be around for a long time. So look how much this guy hit. Not bad. But how much is this up in a year? It's up 13%. So this is a Vanguard ETF. The ticker symbol is VTI, as you can see right here, ticker symbol VTI. So I do recommend buying something like this. Now I just want to take you to show you a more riskier company. But look what didn't make it. Look what didn't make it. Okay, let's go to RGTI. This is Rigetti Computing. Now, I've seen some people recommending this company at $40 a share. $40 a share. And I was like, man, it's already ran up. It's already above its relative strength index. Why are you recommending this company to people? But I don't know. Some people just like to, they like exciting people, but exciting people, that's cool. And I understand this is not TV. You come to the internet to get some good advice, some good suggestions. I would have not recommended this company at $40 per share because the relative strength index that says whether the stock is overbought or oversold. That's what I'm going to check first, and I could go. And I'm going to take you to bar chart to show you what I'm talking about. So let's take a trip to bar chart real quick. Let me type it in barchart.com. And so you can see what relative strength index means. This is bar chart. Hold on, 1 second here. Yeah, sorry about that. I don't know what happened, but I got it situated and fixed. But anyway, I was trying to take you all to barchart.com. Okay, so again, this is what I'm about to show you here. Let's just go there. Let's go there. So Rigetti, right? RGTA, TI, whatever. So so the relative strength index is just a cheat sheet. I go to barchart.com, traders cheat sheet, and I go to right here, RSI. I gotta hit that RSI. So the So these are, of course, these are the prices. So anyway, this this is the 14-day relative strength index at 70%. This signals overbought. So if you see if Rigetti is at $61.97, that means it's in overbought territory. I would not be buying it here. I also would not be buying it at 44. I probably would be buying it at the fourth. I'm buying it at halfway. So what I mean by halfway. So if 14-day relative strength index at 70 signals overbought, a relative strength index at 30 signals oversold. So where is my relative strength index at 30? It's down here. The 14-day relative strength index at 30 is $20.90. Right now, this company is trading at $25.48. So that is it's highlighted in yellow. So it's below it's below 50%. It's below the halfway mark. So if I was looking to get into this company, I would start buying it. I would probably buy it right here. I'll probably buy it right here. And the first, and also what you want to check is you want to check to see if the company's making money. I'm not telling you to buy this. I'm not telling you to buy this stock, but I'm saying Rigetti should not been recommended at 40 something dollars a share up here. Okay. Now I heard some people on the internet recommending this stock. Look what happened last week. So they were telling people to buy. Oh yeah, it's a good stock. You can buy it. You can buy it. When this last week, you can buy it right here, right here, $56. October 15th, this stock was at $56. Look where it's at now. I'm sorry. So I don't know if you can see that. So a month ago, Rigetti was at $56. $56. Now look where it's at. You understand what I'm saying? Now I bought it at $40 a share, and as you can see, I'm down. But I bought it with the specific intention of selling a call option. So I collected, you know, what I did was I said people wanted to buy this company. I said I'll sell this. I sell a stock option on this, and my total return was $400 and 449 dollars. So I collected $449 by selling a call option, a $44 call option. Now, um, so even though I'm holding the stock, even though I'm down, um, even though I'm down by holding the stock, I still made money off the stock by selling somebody a $44 call option that's going to expire worthless by November 28th. If this stock is not $44 a share, I'm still going to keep this $449 period. But you know what I'm saying? They would just be able to exercise it. So I still keep this no matter what. So yeah, the stock is down, but I still made money. That's a little advanced strategy, but that's what I'm saying. You know, I only bought this stock so I could be able to sell other people the rights to my 100 shares. That's what you call a stock option. That's more advanced. That's really advanced. So okay. But if you like this company, I would say you can start buying it at let's go to bar chart at where is that now, because it's one second, where's bar chart? So you can start buying it at now, because if you look right here, it's below its 14-day relative strength index 50%. So it's 25%. As we know with the efficient market hypothesis, right? Which we just seen. What is the efficient market hypothesis? Let's go back to see what that is. 1 second. It's saying that every stock, the price of the stock is supposed to be the price. And if it's not the price, not supposed to be that price, the market is going to tell us so by selling it off. So here you go right here. And then we're going to wrap this. So what is the efficient market hypothesis? Efficient market hypothesis is a hypothesis that states that share prices reflect all available information. That means all available information, all the information they could collect about it, all the information from the analysts, all the information from the PE ratios, from whatever, all the information they got from it, because that's what you do before you buy the stock. So all available information and consistent alpha generation is impossible. So efficient market hypothesis is a hypothesis that states that share prices share prices reflect all available information, and consistent alpha generation, that means a stock consistently going up, is impossible, because every stock has a pullback. There's no straight ride up. If the stock becomes overvalued and you start hearing stuff with inflation, or Trump goes on talking about tariffs again, or he's going to hike up interest rates, then you're going to see people, they're going to sell off this stock. They're going to sell off overvalued stocks and look to get something more like what I just showed you, the ETF, VTI. So they're going to look to get this. They're going to look at some of this, VTI, or this is the ETF. Look, in the last year is up 13%. I could take $100,000 and invest it in this right now. But let's go see this relative strength index. Let's go see where this stock supposed to be. This ETF is supposed to be at. So VTI, okay. Total stock market ETF. Okay. Can you see this? So 14-day RS, the relative strength index is at 350. Right now it's 330. Right now the 50-day, 14-day relative strength index at 50%. It's less than, it's below that. So I'm going to be looking to buy some of this. And if I had $100,000, I would buy this right now. Right now, the relative, I ain't waiting for it to get down here with so the relative strength index at 30%. If it gets down here, that's oversold territory. So I'll be looking to probably get some of this. This is pretty safe. It's kind of like gold. It's better than gold. So I'm not telling people to buy, but if you're looking for stocks that are not too volatile, then you may want to look into something like that, or you may be looking on something like this. This is the last one. We're gonna wrap this up. The VOO, this ETF right here, the VOO. Oh, yeah. So this it's a little bit more expensive, but this is up 14% a year. The stock is expensive, but it still may be undervalued. Here's the companies that's in it. So you may want to get something like that, or if you want some growth, you may could go with the growth ETF. This stock, this ETF, is up 21%. So in a year. So what's in this ETF? Let's go down here. Nvidia, Microsoft, Eli Lilly. That's a medical industry. You got some Broadcom in there, Amazon. They want to get something like that. So this concludes our time for the day. Price earnings ratio, and subscribe, share my channel, and you know what to do. See and join my community. But until next time, see you later. Peace.